You open your brokerage app and you're down 20% overnight. Everything is red. Your thumb is hovering over the sell button. But before you press it, give me 10 minutes. The colour red will cost you more money than any bad trade you'll ever make. Not because of what it means, but because of what it does to your brain. Red subconsciously means poison, danger, blood. Your portfolio drops and your body reacts like you're being hunted. Think about it. If you were being chased by a lion, would you be on your brokerage app making investment decisions at the same time? Probably not, but investors do it every day. So here's what I do. I go into my brokerage app and I switch every red to blue. Green is growth and blue is the washing out of speculation. Just look how different this chart looks. An investor is much less likely to panic sell something that looks like this. That one small change makes me calmer and more rational. And that matters most in a bear market where seeing red every single day wears you down and pushes you into emotional selling you'll probably regret. If your app lets you change colours, give it a go and let me know how it goes. That's the first part of handling a drawdown. Finding lots of little strategies to help you manage your emotions. You need to think rationally before you make a decision. Whether you should sell in a crash has nothing to do with the market. Absolutely nothing. It has everything to do with why you bought. If you read the financial statements, studied the industry, and sat through the earnings calls, if you decided the market was underestimating a certain asset, and you dollar cost averaged into a position, sized so that you could sleep at night, then the crash didn't change your thesis. It only changed the price. Crashes shake out plenty of people out of good investments, and the assets that are genuinely undervalued going in tend to recover first. But if you lump summed into a huge position because the price went up every day, and you got sick of watching from the sidelines, if you bought call options instead of the actual asset, that's a conversation you should have with a licensed financial advisor as soon as possible. Look, if you're new to investing and that stings, I get it. I made many of the same mistakes in one form or another when I first started. Treat it as tuition you paid to the market. You are now a better investor than you were before, and that's worth something. Either way, don't panic. You will get through it. Experienced investors sell their losers on purpose, often not because they gave up, but because of what it does to their tax bill. In a lot of countries, a realised loss can be offset against your future gains for years. So when a position is deep in the red, some investors sell it deliberately, just to lock in the loss on paper. What they do next depends on the country they're resident in. If there's no wash sale rule, they can simply buy the same position straight back. If there is one, like in the United States, they buy something similar instead. They sell SPY and buy VU, sell Visa and buy MasterCard. Same exposure, different ticker. People will tell you never to sell, but tactical selling in a crash is how long-term investors build a tax buffer, so when the bull market returns, they can rebalance and still keep more of their gains. Doing this also stops you from having to stare at loss-making positions for a long period of time. It's a way to make the most out of a bad situation. The rules change from country to country, so speak to a local tax advisor and they'll be able to help you understand the situation. The most convincing market recovery you'll ever see is the one designed to wipe you out. Whenever the market crashes, everyone's starting to hunt for a V-shaped recovery, the clean bounce. And a bear market rally looks exactly like that. It fakes the V shape perfectly, so you'll feel the pull to lump sum in and be the one who called the bottom, maybe with leverage. That's where people get destroyed, because when these rallies fail, they fail hard. 1929 had multiple false rallies before the real bottom. The dot-com crash, same story. Round after round, speculators got cleared out until only the long-term holders were left. That doesn't mean stop investing. Anyone telling you to do that is doing you a disservice. Nobody times the exact bottom, so when I see something I believe is undervalued, I just start dollar cost averaging, an amount I could lose completely without it wrecking me, invested every single month. That works for individual stocks inside a portfolio too, by the way, not just ETFs. Still bearish? Then hold a greater part of your income back as cash and let ultra short duration treasuries pay you a small, low risk return while you wait. You don't need to express a bearish view by failing to invest. You can always dip your toes in and see what happens. A bear market is the only fire sale nobody shows up for. Everything you've been watching finally goes cheap, and suddenly nobody wants to buy it. Your screener fills up with quality companies at prices you dreamed about a year ago. That's your reward for being the responsible one, with extra cash set aside. Don't rush it. Research, build a watch list, take your time. There's no prize for lump summing in fast. The stocks that eventually run the hardest usually spend the longest time going sideways first. And there's a reason for that. Strong hands dollar cost average in slowly. A long, boring consolidation filters out everyone who'd panic at the first wobble and leaves behind the kind of holders who don't sell. After a crash, when you go onto social media, most people will tell you that it's over, that you'd be a fool to buy. The problem is that sometimes they're right. Sometimes a company is a value trap that just keeps drifting downwards into insolvency. Other times it's the buy of the decade. The financial statements usually settle it. If you read them carefully and you read the other disclosures, then most of the doubt disappears. And here's the trap. Every one of these stocks looks obvious afterwards. You pull up a chart a year later and think, how could anyone miss that? But standing in it, with the sentiment as bad as it gets and everyone calling it dead money, obvious is the last thing it feels like. For timing, different people handle it in their own way. I have a natural tendency to lean bearish, so I've built myself custom indicators that combine all of my technical analysis research and backtesting, telling me objectively when to start dollar cost averaging, instead of my emotions deciding. It's not perfect. It doesn't need to be. It just needs to stop me from hesitating at the worst possible moment. If you've survived a real bear market, then you know things most investors never learn. Most investors quit during bear markets and come back only at the end of the next bull market. So if you've made it through the crash and the long grind after it, congratulations. Genuinely, that's something worth being proud of, even if you lost money along the way. I can usually tell, talking to investors online, which ones have lived through a difficult market. They think differently. Risk management sits at the top of everything, and they treat multi-decade outperformance as an outcome of that, not of one genius trade idea. They know unrealized gains can go back to the market in a heartbeat. You won't catch them bragging about their returns today. Instead, they live in this liminal space where compounding, inflation, exchange rates, reflexivity, 100 other forces push on each other while they quietly ride the currents upward. They've realized that in the long term, avoiding losses is how you win the game of investing. That's it for this video. For more content like this, hit like and subscribe. See you next time.